Hello, everyone. Welcome to the Fall Investment and Economic Update webinar. This is Melissa Joy, and I am thrilled to be joined by a couple colleagues who I'm going to introduce in a moment. And I just feel like the time is so right to, kind of lay the groundwork, set expectations, and remind you about, kind of how we think about investing. There are so many voices in the air that are telling you how to think. And I think it's just a great time to kind of level set. So good timing. Thank you for joining us. I am going to get started. If you are joining us a little late or have friends that want to listen, then, please do know that we always have these podcasts recorded and we'll be sharing them. And Melissa, can you just nod your head and let me know that it's showing the full screen presentation?
It is.
Yeah. Okay, perfect. Okay, well, here we are. This is the team at Pearl Planning, and today I am joined by Melissa Fradenburg as well as Hannah Near. They're both financial advisors here at Pearl Planning, and we're going to divide and conquer and talk to you all about current events, what's going on in life. We've got a jam-packed agenda with both timely narrative about today as well as age-old wisdom that we think is always evergreen to remind you about. So without further ado, here is our agenda. Given the events over the weekend and the war in Israel, I think we will hit on that first. Very much a humanitarian issue, but it also has some impacts on the market. So we're going to cover that first. Melissa has an economic update for us, followed by what is going on in the stock market from Hannah. And then I really feel like right now it is time for us to get back to basics when it comes to bonds, because we have a radically different bond market than we've had for much of the last 10 years or even longer. And so it's time to revisit the rules of bonds and how they work and what we think about the bond market today. And then we'll wrap up by how do you invest from here? We'll talk about our perspective and how we're putting portfolios together, as well as that age-old wisdom that we reminded you about. Starting with a very difficult topic, we want to talk about Israel and the news in Israel. Hamas, a terrorist organization sponsored by Iran, attacked Israel, and now Israel has declared war. And we have been watching, the humanitarian tragedy, the impact on civilians, both in Israel as well as Palestine. If you were watching the markets this week, I wasn't necessarily surprised that news didn't directly, immediately, kind of pull markets down. It's hard to remember that current events and tragic events aren't always tied to investment returns. Where would there potentially be impact? Of course, Israeli companies are impacted in terms of their abilities to do business. This action is obviously a destabilizer when it comes to the Middle Eastern region. And additionally, while there isn't oil production in Israel itself, there is the potential for destabilization in terms of energy production, although notably energy prices remain lower this year and do not seem to be that the immediate impact of the war is destabilizing. And it's really difficult for me to talk about the numbers of what happens when something goes bump in the night and bad things happen in the world, because it feels so dehumanizing to talk about, kind of just the financial things. But I did want to share with you kind of a list of events. This is from Carson Group, of just horrible things that have happened over going back to the 1940s. So the last more than 80 years. You have World War II events, you have obvious significant disruptions in foreign events, and also things that are happening here. And in aggregate, when bad things happen, it doesn't necessarily mean that investment returns are bad over any given period of time. In fact, the median returns are often positive. And when you see that, over 6 and 12-month periods, oftentimes on average, they're also positive when it comes to the stock market as measured by the S&P. This doesn't really surprise me because the stock market, if you flip a coin, is going to be heads 7 times out of 10, not 5 out of 10. And this is just kind of the way the world works. So this is a precursor to our upcoming and forthcoming later in our session conversation about politics as well. We're entering a presidential election year, but do not think that your investment decisions necessarily need to be tied to your perspective on foreign policy or your perspective on world events. Just a reminder that, kind of longer term investors tend to be well rewarded for not kind of being extraordinarily defensive when bad news happens, which unfortunately is all too often. So with that kind of somber and downbeat note, I'm going to hand things off and see if Melissa Fradenburg can be a little more upbeat when it comes to something that people love to hate, the economy. Melissa, can you give us an economic update?
Absolutely. Well, yes, I'm going to start with the positive here. And in putting together kind of the slides on the economy, I was thinking about, we do these quarterly, these webinars, and we've been talking about the Fed raising rates and the speed at which the Fed has raised rates, and the reason for that being that the economy came out hot from COVID, and then we have had inflation. Everybody has felt that. The Fed has raised rates trying to keep inflation down. And so the positive news is that we are seeing some alleviation to the inflation that we have experienced. So goods prices are on the decline, as you can see on the chart on the left. And then while the CPI numbers, which is the light blue line on the slide on the right, don't show it as dramatically, those are not real-time numbers. If we look at real-time data from rent.com, we're actually seeing a quite dramatic drop in shelter or rent prices year over year. And those are good things, because those numbers are, one, showing that the interest rate hikes are working to slow the economy, which is what they're intended to do. And then also, it gives us hope that the Fed is almost done with raising rates, right? If we go to the next slide, this is kind of the bad news, if we will. With those increases in rates, we're seeing that the consumers are feeling it. If you are looking at purchasing a home, especially if you're mortgaging that home at current rates, the Pearl Planning Grosse Pointe office is right across the hall from a mortgage lender, and I just heard him quote somebody at 7.99. So mortgage rates have come up dramatically. If you're in the market for buying a new vehicle, if you're going to finance that vehicle, or even just the cost of vehicles is up, so you're going to feel that. Consumers across the board are feeling that, and we are also seeing increases in oil prices, which you're going to feel at the pump, and also to heat your home if you're in a cooler climate like we are here in Michigan. So those are the things that we're thinking about when we're looking at the economy. The other issue is that we had excess savings from all the stimulus over COVID over the last few years. We are seeing that declining. So that stimulus is just about spent. And so this is kind of the negative slide after the positive slide about inflation coming down. And if we go to the next slide, I'm going to also have a positive slide to back that up, which is, even though we're seeing that savings, that excess savings that we had from over COVID decline, we are actually, if you look at personal savings rate as a percentage of disposable income, it's the blue bar there on the left for 2023. We're actually up slightly from 2022. And if you compare that to, say, 05, 06, leading into the 2008 recession, which is what everybody kind of is still fresh in their mind and thinking about when we talk about the R word, a possible recession, we are in a much different place right now. People have higher savings rate, albeit slightly below average. We are still at a space that is much different from what we entered that 2008 recession. Also, if we look at credit, so the chart there, the SAAR, revolving consumer credit outstanding, you can see that we are on an increase from the levels we saw in 2021 and 22, but going back, we are much lower than the rates that we saw leading up to 2008. So that is the good news there. And actually I have some more good news. Again, talking about the possible recession, I know for at least the last 4 or 5 quarterly economic updates, we've talked about, are we going to have a recession? Is it coming? This possible recession would be the most widely anticipated recession that we've ever had. But all I could think about when putting together slides was and I might age myself here for some of you younger people, but the Wendy's commercial, the "Where's the beef?" Going back to the 1980s, and these like older ladies here that became so popular in this ad. Where's the recession? Where is it? Well, some economists are saying we're going to see it in early 2024, but here at Pearl Planning, we're really tired of predicting when the recession is going to happen and if we're going to have one. But what I can say is we have to invest for the long term. We can't think about what's happening, in this quarter or next quarter necessarily. But when we look at some of the positives that will reassure us that even if we do actually have a recession, that it should be on the mild side. We are not seeing the over leveraging, like I showed in the slides there, both consumers and businesses, like we saw in prior cycles. We still have a relatively healthy job market. So yes, we could experience job losses. I know we've had clients, I have friends who've experienced job loss in the last 6 months, and we can continue to see that, but it's not going to be like the historic job losses we've experienced in past cycles. Also, we're not in a housing bubble. It may feel that way if you look at housing prices, but there's still a low supply of housing, which is causing those housing prices to go up. We're still seeing solid government spending. And then as far as a big recession happening, most economists are talking about just rolling recessions in certain areas of the economy. Certain areas we've already experienced downturns, like post-pandemic revenge travel sort of coming off of its high, and we're seeing air travel prices go down lower and hotel prices go down lower. So rather than saying, we're having a recession, this is when it's coming, the likelihood that we could possibly have one, sure, but it's most likely going to be mild, and I'm not going to make a call on when. So with that, I am going to pass it to Hannah for some outlook on the equity market.
Thanks so much, Melissa. So I wanted to talk a little bit about the stock market, and in particular, we wanted to kind of start by explaining some of the historical seasonal patterns we've seen over the years. And we can start by kind of looking at the market trends we've seen so far in 2023. From January to July this year, which I'm sure most of you remember, it's not too far removed from our memory, the S&P was up by about 19.5%. The following 2 months, so August and September, the S&P was down by about 6.5%, 6.56. So what's really interesting is this is a common pattern that we can find when we look back through historic annual returns over time. So if we look back all the way to 1930, there have been actually 12 prior years when January through July was up by at least 10%. And then August and September were subsequently negative. So the interesting thing and potentially optimistic thing about these years is that in every single one of those years where we saw that pattern, the following fourth quarter saw a bump in the market of at least 2%. So that would bring the historic average annual return in similar years to about 8.39%. So we don't tell you this to try to make a prediction about the end of the year or any guarantees about what the market's going to do. However, sometimes when we look back at historic market trends over time, it can just kind of give us some optimism and perspective on the big picture in the market as an investor. So moving on to the next slide. We can see here that the average percent change in the S&P each month of the calendar year going back all the way to 1928. And we can see again, September has historically been a challenging month in the market with an uptick in those last 3 months of the year. So it can be really easy to feel some fear or pessimism in months like we've had this year in September. However, time and time again, investors are rewarded to kind of have patience and willingness to stay invested during those down periods in the market. Okay, so we also wanted to talk a little bit about the breakdown in performance of companies within the S&P 500. So we're honing in on 2023's S&P 500 performance here. And at this point in the year, 7 of the 500 stocks in the S&P 500 have really been the heavy lifters in the market so far this year. Those 7 companies, which is not probably surprising to anyone, are primarily tech-related companies. And these 7 companies are up more than 50% so far year to date, with those remaining 493 companies staying relatively flat so far this year. So the reason that this is relevant, and the reason that we wanted to bring it up, is there's so much talk about the market being so strongly overvalued right now. But when we really break apart the S&P 500 to kind of look under the hood and see what all of these companies are doing, these 493 companies within the S&P have a valuation that's still considered to be pretty reasonable. So essentially, we think there's still room for growth potential, and valuation overall, I should say, hasn't gotten as far out of control as maybe some of the headlines might lead us to believe. Okay, so on this slide, we wanted to kind of show what many investors refer to as kind of the lost decade, or the fallout, or the fallout from the tech wreck. So here we're looking at emerging markets in blue, mid cap in purple, and then large cap in orange. So although in today's market, it can feel like large cap is really kind of carrying us home or carrying our returns, it's really important to remember that there have been periods in time historically when large cap has really underperformed, and owning small and mid-sized companies has been really beneficial to your overall portfolio. So the lost decade was one of those time periods. So we can see here, starting in 2000 and ending in about 2011, emerging markets was really leading the pack with returns of 223% over that time frame. Mid caps came in at about 80% returns over that same period, and large cap was actually down by about 4.5%. So sometimes it's really easy as investors to kind of extrapolate the current market conditions over the long term. However, when we kind of revisit some of these historic periods in time, we're quickly reminded that owning kind of a mix of diversified funds is really the most valuable way that you can hedge against market uncertainty. So moving on here, we wanted to also talk a little bit about growth versus value stocks in the market. And this has been a really hot topic in recent years. This chart shows the relative total returns of the Russell 1000 Growth Index versus the Russell 1000 Value Index. And we can see that over time, there have been periods when growth has been more lucrative, or periods when value has been more opportunistic. So over the past several years, there has been so much talk about growth kind of dominating over value. And it is true that in recent years, there has kind of been a more steep divergence between growth and value. But growth did have a steep pullback in 2022, and that has kind of narrowed that gap a little bit. And continuing on to the next slide, we can see exactly why it's so critical that you do own both growth and value in your portfolio. If we look to the left of this graph, we can see growth trailing returns over 1, 5, 10, and 15-year periods, ending in March of 2000. So on this left side of the graph, growth is shown in the dark green, value shown in light green. That growth did outperform during this period of time. But if we look to the right of this graph, we can see trailing returns over those same periods, but ending in March of 2001. And we can see that over this time period, the trailing 1 year of value absolutely dominated over growth. So the moral of this story is that although there can be periods of time where it feels where it doesn't feel beneficial to own value stock, one swift market event could really make holding those value stocks worth it. And it just speaks more so to diversifying of your portfolio. So we wanted to touch also on small cap companies, because this is another area of the market that's perhaps felt a little bit frustrating to own over the past several years. And in this chart, we can see the price to earnings ratio of small caps has really come down pretty significantly in recent years. So just as a reminder, price to earnings ratio is just kind of a way to value a company by comparing the price of the stock to that company's earnings. And it basically tells you how much you're paying for each dollar of earnings for that company. So we can see on this graph that small cap looks relatively inexpensive right now. So we wanted to just kind of use this as another example of why it can be productive to hold on to your full diversified portfolio, even when it feels like a small portion of your portfolio is carrying your overall returns. The same funds that have felt like underperformers in recent years could potentially see some growth, room for growth in these upcoming years. So again, the overall message when it comes to the stock side of your portfolio, it continues to pay to diversify. These dips in the markets can be a really opportune time to rebalance, to kind of revisit your investment goals and your overall investment strategy. But most importantly, it's really good time to stay invested in your full diversified portfolio. And this allows you the best opportunity to be prepared for the many unknowns that the stock market may bring us. So with that, I will pass it over to Melissa Joy, who is going to discuss the ins and outs of the bond market.
Well, that was an excellent summary. I feel like I've had several conversations, and probably those of you that aren't having these discussions with us may be thinking in the back of your mind, like, hey, I think, a bad economy is coming. Why don't we just sit it out? And I think that there's a lot of reasons to be optimistic, whether it is the reality that this recession we've been waiting for hasn't materialized yet. And certainly there is a recession in the future. It's just a question of when, but it could be tomorrow and it could be 5 years from now. There are parts of the market that are much more attractive than the 7 biggest, growthiest companies in the market. And Hannah touched on a lot of them, the rest of the world, as well as mid and small companies and value companies. And then let's talk about bonds, because the bond market has radically changed. And we'll start with the bad part, which is the last 3 years have been just the absolute worst time to own bonds in history. So you can see in this group of returns, we go back to 1928, green is up, red is down, and you can see that there's never been a group of 3 reds in a row until 2021, 2022, and we're holding out to see how 2023 ends, but it's not looking good so far. So just an absolutely terrible bond market in terms of bond returns. This is a look at the averages. How have we been, as investors, tried to defend against the bad returns in bonds? We still do own indexes that have bond coverage like these returns, but we've kept what's called duration, or when bonds mature, shorter. We've also owned some alternative types of investments that have bond-like returns, but do not rely on interest rates and bonds to get their returns. And then we've had active bond managers that have effectively tried to mitigate some of the risks or the downside in bonds. But I would tell you, sitting here in 2023, in a time period where in modern stock market history, there has not been these 3 negative years in a row, that it is possibly a very good time to be a bond investor. And there are a lot of the math of bonds that are really working in your favor if you're a retiree, if you're someone who owns bonds in your portfolio. So a really bad kind of mix of bonds has turned into a much more favorable looking forward. And I want to talk a little bit more about that. So when you look at bonds right now, we have what's called an inverted yield curve. And that is like a super wonky way to say that when you have, you get paid more for bonds that mature within a short period of time, like let's say 1 year, you lend somebody money, they're going to pay you back within a year, versus bonds that mature over 10, 20, or 30 years, or even over 3 or 5 years. So you get paid more for something short than something long. That's unusual because usually when you have the risk of giving up your money for a longer period of time, people are willing to pay you more. And we can see that most notably in that cash or money markets yields more than 5%. That's really incredible. That's just a fantastic number. You can see in the chart on the left what the yield of cash has been over time. And you can see that flat line down at the bottom for most of the last 15 years, where you just haven't been paid much of anything to have cash in the bank. And you may need to be describing to your, if you have Gen Z kids, you may need to describe what interest means when it comes to the bank, because it just, you haven't had any examples in the wild to show that. But interest rates have gone way up over the last year and a half to more than 5%. And I get that there's a natural instinct to then say, hey, I think I should just put all my money in cash because that guaranteed 5% feels really darn good. The reason that we don't recommend that is because that as quickly as that yield went up, it can also go down. And while I certainly want you for the cash that you have on hand, that's not just, kind of needs to be in the checking account, to shop around for higher yields because they're out there, they're easy to find, and they're safe with often with FDIC insurance. Do get the cash that you have on hand with yield. And there's nothing wrong with having short-term bond exposure, which has similar yields as well. But this may be a moment in time where it is worth it to lock in some interest rates that are higher, because on the next slide, the reason that there's this inverted yield curve is because the world is anticipating that interest rates may go down. That's, basically the price that people are willing to pay for a bond in 3 or 5 years is based on the expectations of the market, which may or may not be correct. I will tell you, over the summer, I heard very strong opinions that we had seen the highest money market interest rates that we were going to see it for a long, long time. And that was not the case. Interest rates went higher and higher for the rest of the summer and into this fall. But the forecast is that interest rates will be down in the future, which means that the market thinks that, perhaps locking in interest rates for some of what you own in things that mature in 3 years, 5 years, or 10 years, and having a diversified bond portfolio, just like Hannah was explaining to you about having a diversified stock portfolio, makes sense. So we think this may be a time where it makes sense to buy some bonds that are a little bit longer duration. One of the reasons, and I'm going to get super wonky here, I apologize. I'm happy to talk with you after the call if you want to follow up and you have questions on this. But when interest rates are low to none, as they were back in 2020 after COVID hit, and you had interest rates on treasury bonds at 1 or 2%, if interest rates go up from there, it is just decimating to bond returns. And that's what we've seen, because one of the ways to offset higher interest rates, which changes the price of your bonds, is to know, well, I'm going to get paid though. I'm getting paid a coupon. I'm getting paid 1 or 2%. Well, 1 or 2% doesn't cover it when interest rates go up 1,000 times from where they started, or go from 1% to now 5%. The math is radically different when interest rates go up, but they pay a reasonable yield. So this is an example where you have interest rates right now yielding 5.4% on a bond. This is just a sample. This is actually the index as a sample. So, and on average, if you take all of the bonds and put them together, they will mature on average in 6 years. Okay, so that's their average maturity. Actually, interestingly, it's not their average maturity, it's called duration. That's a measure with the money that you get paid back when bonds mature, plus the interest of how long you have to put the money in to kind of get it back. And you'll notice in this chart that duration has actually gone lower for the index. So then, if interest rates go up by 1%, you still get this 5.4% yield that you have received from the index, and then you have a price return that's -6. So then you have a -0.8 return. Not our favorite thing, but it's also not negative 10% like last year for similar, kind of interest rate moves. Let's say rates don't change at all. Well, then the price doesn't change and you get paid that yield of 5.4% and you're sitting there happy. And then let's say interest rates go down. And why might interest rates go down? Raise your hand if you're one of the people that's more skeptical than Melissa Fradenburg, who's thinking, oh, nope, there's going to be a recession. I'm sure of it. Well, if interest rates go down, then your bond yield, you get that 5.4%, but you also get a positive return on price. If rates in this theoretical forecast go down 1%, so the Federal Reserve lowers rates, or even the bond market can anticipate the Fed lowering rates, and that could be the way the rates go down. You get 11% return from your bonds in that time period if they don't have credit risk, if they're not high yield bonds for companies that might be going bankrupt or things like that. Gosh, that math is very attractive. This is the way markets normally work when you don't have a very, very low interest rate environment like we did with the ZIRP or zero interest rate environment. Bonds look much more attractive on multiple levels. First of all, they're paying you yield today. So if you're an investor, a retiree who's trying to limit the volatility in your portfolio, you are actually getting paid. Thank goodness, finally. And yes, we've had to go through pain to get there with negative returns, but now we have a much more optimistic kind of outlook when it comes to bonds going forward. But additionally, bonds then would provide protection when interest rates fall if there's a recession. And so that, again, is another just, return to normal. The reason that people own bonds, some people need to be reminded that there is a reason, but that would reduce and dampen volatility in portfolios if stock markets were falling because of the impact of recession or overvaluation, et cetera. So this is this is great news, but you do not get that positive price return if you choose to just keep the money in cash. The price stays $1 and the interest rate goes down, and then you're sitting holding something that was yielding 5.3% and now yields 4.3%. Not a bad thing still. I'd be happy to be paid 4.3% when interest rates go down. But the function of bonds, the ability to dampen when returns go down by having a price go up in bonds, is something that you need to own bonds, not cash, in order to appreciate. So I hope you appreciate at least this kind of basic boot camp on bonds. We'll continue to talk about them more over time. In terms of portfolio moves, just like we're paying attention to diversification, as Hannah mentioned, and may even be increasing the areas of the market that have lower valuations or haven't participated in the upside, we also will be looking carefully in terms of our decisions of how much bonds to own and how long it takes for them to mature. Because again, it's a very interesting and much better market for a bond owner. Of course, if you're a borrower, not as good because you're paying higher interest rates. But we're putting all of that information to work in terms of our portfolio management. Okay, let's talk about a little bit about market history. As I'm wrapping up, I wanted to mention that there is a Q&A where you can type in questions and we will be happy to answer them for you. We can always follow up individually if you email us, but we're not done quite yet. I want you to remember a few things from here. The first thing is there are trends when it comes to presidential election cycles. And again, this is hammering home what Hannah was also talking about. The third quarter of a presidential election cycle tends to be a very low quarter with less percent of time where returns are positive. We're entering in a much stronger period of time. And again, that's not a prediction, but I always like to use information that helps people to remember that they're long-term investors and hold on, because it's so, especially if you're nearing retirement, it's so easy to just want to avoid the down days. But we know, at least in our experience, that is really difficult to navigate if you're picking the days or months that you choose to invest. Coming into the next year, I just want to give you a pep talk because we have to talk a lot more about politics than we would like to when it comes to presidential election years. First note, markets do not care who is in office. Yes, of course, there are impacts from policy. There's impacts from tax guidance, but in general, there is information that whichever party is controlling whichever part of the government, that the stock market does not care. In fact, the more fracture, the more disrupted, the better. In years like the year four of the presidential election cycle, markets tend to be higher. Oftentimes there's kind of a relief rally at the end as kind of things tend to resolve themselves. But, if you're asking whether it's from our recession forecast or from our valuation forecast, or even from, that just like, I hate American politics. And I mean, there's no question. It doesn't matter who you're voting for. Nobody seems to love it. That is not a reason to stop being an investor, just as a reminder. Do try to listen less to all the negativity often being sold to you by people who have something to sell, and do think about the, kind of the long-term lessons of markets. We're also, surprisingly, because we're coming off of a weaker time period, we are in a bull market, a new bull market. In fact, even though the last quarter was kind of a disappointing quarter when it came to returns, which you've got to be an investor that is willing to kind of sit through those quarters. If you look over the last year, believe it or not, we entered the new bull market in October of 2022. And since then, going through last week, the market's up 19.9% if you measure the S&P. Shocking. And, that fourth quarter was one you did not want to miss by sitting on the sidelines. It was also the most, the time last year where I got the most phone calls saying, I just don't love it. I don't feel like the future is bright. I don't want, I would like to change my investment allocation. So it's funny how that happens. Those are the moments that I tend to know, oh, we must be getting to that inflection point where the market is going to start recovering. And I really work hard to make sure that our clients are participating in that recovery. Second year after the first year in a bull market, which we tomorrow is the anniversary of year one, second year tends to be higher as well. So on average, 13.5% higher in the second year of a bull market. This is data going back to 1950. So take note, this is not a prediction again, but this is probability. This is statistics, and it tends to be higher. We can always have exceptions, but good news if you're looking for good news to remind yourself why to be a long-term investor. There are so many inflection points in the market. And I think this is just a chart this is going back to the mid 90s, and it's just looking at the S&P. There's big periods here where you'd want to listen to Hannah's part of the presentation that says own value, own smaller companies, own the rest of the world. We're doing that for you. But when you look over time, the market tends to move higher over time. It flattens those years long ago because it keeps marching forward. I think it would be easier to show you kind of in a different way, kind of tying back to the, always having negative events in the world. This is looking back to a similar time period from the late 1980s. And each rectangle in black is a reason to quit investing, is a reason to sit that year out. Whether it's a recession in 1990, which we probably, most of us don't even remember, 9/11, looking back, in this time period, it's not even on the chart, but we had, nuclear plant that had a meltdown in Japan, a huge decline as we entered COVID, and horrible inflation over the last few years. And yet, where there's a will, there's a way. Investing in stocks tends to go higher over time. This isn't a prediction. You can see how often we have recessions, because those are the gray areas, and how often we're not in recession. Recessions tend to be short, and almost every time the market starts to recover before the recession ends as well. So there are so many reasons not to invest, but this is just a reminder of all the excuses you could have had to get out and why you might want to stay in. Inter-year declines too. In any given year, the market's down more than 5% 3 or 4 times. The market's down more than 10% every other year on average. And sometimes it's down even more than that. The red dot is how much the market's pulled back during the year. And the black bar, or the gray bar, is how the market's done through the year. And this is using the S&P. So again, there's always going to be head fakes. There's always going to be mind games. There's always going to be reasons to say, you know what, I'm just not feeling it. I want out. And this is an important reminder that with those constants, you get positive returns over time. And we don't always show this chart, but the same goes with bonds. Interest rates float up sometimes, and that is negative for bonds. But when you look over time, and this year and last year are definitely no exceptions. But over time, again, bonds tend to have positive returns. Look on that left side of the chart, much more dramatically positive returns than on the right side. I'll tell you, we're in an environment that is much more similar to the 1990s than it is to any of recent history when it comes to bond returns. When I started in the business, money markets yielded 6%. And so that is a reality. It's not unusual. And we're kind of in normal interest rate ranges right now when you look over long periods of time coming out of a historic low. So again, as a bond investor too, there's a reason to kind of stick around. With anything, we think that investing with a longer time frame, a longer focus, don't focus on the days, don't focus on the headlines, and certainly don't focus on fear tactics, helps to have healthier returns over time. Because investing in the short term, and borrowing from Warren Buffett here, is a voting game. It's, kind of a popularity contest, and the best winners don't always win. But over longer periods of time, it's a weighing game. It's an economic game. It's a proof of concept of capitalism and companies and investments. And so longer periods of time tend to result in more predictable and stable returns. I always like to include our emoji chart, our emoji guide, and I would encourage you to think about which emoji you are feeling right now, because constantly there's a period of time, whether you're just, kind of feeling the pain of the market, or also feeling the FOMO and feeling like everybody's cashing in and I want my lottery ticket too. Those that are rewarded most are those whether you have those feelings, because we all do, we all feel either the greed or the fear or something in between. If you can approach your investment decisions with the flat face, with a face that just says, here's my process and I'm sticking with it, that is where you get the results as a successful investor. So, pick your emoji. It's always good to have a little journal and be like, I'm riding high or I'm riding low. And then remind yourself that your emoji emotions do not have to be the way that your portfolio behaves. If you feel like you're constantly in that swing and you're self-managing, then, that's where an investment professional may be able to provide assistance. And we're not immune to the emojis, I will say. We just use process and discipline in order to overcome the obstacles of investing emotion, because it's really difficult not to feel it. Okay, I always have trouble getting to the next page. I love this quote from Michael Antonelli. We are in a world that will always jump to the worst case scenario whenever something happens. And I totally borrowed this cartoon from him. This is somebody, it's a beautiful day. We just had a beautiful fall day, perhaps in Michigan. And all the person sees is the rain in the forecast, or they've chosen, like my daughter who loves to watch disaster shows on YouTube. That's what they're watching with their umbrella in hand. I've actually read studies, and I want to do some writing on this, that more optimistic people have better results as investors. And I want you to incorporate optimism and belief into that. Doesn't mean you can, everything has to be hunky-dory, but it's helpful to know that the investing world is full of possibilities, not pessimism, and that you have abundance in investment returns and surprises on the upside, not just scarcity. And I think it's important for us to talk about that more, because when you turn on the evening news, fear sells. When you click, I should modernize my language. When you click on an article, it's fear that sells. And, for the investor, living under a rock and feeling fearful and seeing the rain when it's really a beautiful day doesn't get you the same results that being even keeled and rational, but also looking long term and knowing that there are possibilities can do. So it never feels like a good time to buy. And that's where your process and being, kind of having a method to the madness can really help. Just a pitch, I will say that people tend to feel more confident about their financial circumstances when they have professional advice. Totally conflict of interest here because we are professional financial advisors. But that's the results that you tend to see, is that with financial planning, people feel more confident about their goals and their results. And I think that's an important reminder. And we are coming toward the end of the year, where there are a lot of opportunities to kind of be on the right page when it comes to your finances. And if you're feeling more pessimistic, guard against that pessimism with action and planning. So how do we invest from here? I think the best actions from right now, I've really been hammering this with the last few pages, is to manage your emotions. Don't be over exuberant, but also don't be overly pessimistic. Focus on your long-term financial plan. And if you don't have one, get one. Rebalance. So your bonds may be a little lighter, but we just made a case that it's worth it to own bonds today. You may have huge winners when it came to NASDAQ names or big tech companies. Well, trim some of those winnings so that you are selling high because you bought low, and reinvest in some of the areas that Hannah pointed out. Be tax aware. Whether it's which account you choose to pull from during retirement, or how you invest as in a taxable brokerage account. There are so many opportunities. This is the number one thing I see when people come to us in the beginning of like, hey, we can really make a difference in terms of your tax decisions, which just means more money for you and less money for Uncle Sam. You may want to do some Roth planning when it comes to year end, and that's something that has to be done by 12/31. And hey, if you have cash sitting on the sideline, a lot of people come to us and they think, oh, they're going to say that's too much cash. And no, we actually love cash. We think it's important for making the world spend. It's important for your household. It's important for when things go bump in the night. But do get paid a yield, because otherwise you're giving the 5% that you can get in certain accounts over to your bank. And they love that for their bottom line. That's why last spring, when people were fretting about, kind of banks, I was like, they're getting a lot of free money because people are keeping their deposit accounts and not getting higher yield. So do know that action right now. That's just a short list though, because we're going to have a 45-minute presentation in November that's all about your year-end financial and tax planning. This is a deep dive into financial planning, which is different than investing is a part of it, but there's so much more. And I do think this is the most important actionable webinar that we do each year. Each year it gets better, and there's so many things for us to talk about this year. So quick plug, if you go to pearlplan.com/events, you will see registration link just like you signed up for this presentation today. And I'll also mention, if any of you are University of Michigan employees or you have friends who are, we're doing a webinar next week that is about your benefits decisions, especially because they have some new options this year. So both of those are available, and you can always sign up for our newsletters on the website too, so you get information about forthcoming events, because we love to get important, relevant information into your hands. I don't see any Q&A yet, but if anybody has any last minute questions as I kind of scroll through and tell you how to find us, Hannah and Melissa are both, as well as myself, are all on our website with calendar links to schedule if you want to follow up. And I always forget to include disclosures, so I put them before the Q&A slide. But we welcome your questions now or as follow-up, and we love to have the opportunity to have these types of discussions. So thank you for listening, and we got a great attendance today, and we're also going to be sending out this webinar as follow-up. Here's a look at all of our team as well as our locations. We're in Ann Arbor area, Grosse Pointe, and serve all of Metro Detroit. Our divorce financial planner is in Birmingham, and then Hannah is in Charlevoix. Beautiful place to be, and enjoy the Apple Festival this weekend, Hannah. With that, though, we're going to sign out, and you can always reach out to us if you have questions or if it's time for you to get, kind of things solid on your financial and investing plan. Thank you so much for attending.